Barney, shall we start in the next minute?
I think probably good to start now, Neha, if you're ready.
Okay, fine. Okay, then I would say a very good afternoon to everybody who has joined in today. This is a much awaited hour. This is the launch of our global flagship knowledge product. This is what we call SOTM, an acronym that everybody should remember. State of the market. And we do it globally, we do it regionally, and we do it for countries. So thank you all for joining today at the launch for the India Sustainable Debt Market State of the Market Report 2024. Good morning and good evening to participants joining in from different time zones. I am Neha Kumar. I head South Asia for Climate Bonds Initiative. And let me welcome everyone who has joined on behalf of our partner MUFG and Climate Bonds-led India Initiative on Climate Risks and Sustainable Finance. This report is coming after, this edition is coming after a gap of 3 years. So it is full of, deep insights, awaited insights into the stock taking that we have done on deals, trends, instruments that have been growing in the Indian sustainable debt market space for the last 3 years. It also takes a very honest look into what is required to push the growth even further to meet the climate finance needs for Indian targets and for India's net zero journey. I will give you a very quick run of the flow, then I will hand it over to our speakers. I welcome everyone who has joined in. We are honored to have Mr. Pramod Rao, Executive Director at SEBI, who will be delivering the keynote address. Our esteemed speaker from Ministry of Finance, Ms. Chandni Raina, has been just called into another meeting. She may join at a later point, but we will in any case start the proceedings of the webinar. My colleagues at Climate Bonds, Rupa Satish and Caroline Harrison, will give you the highlights in a presentation of what the report is all about. After that, I'll request everybody to switch on their cameras, and there will be a short but very awaited moment when we will release the report and it will go live. After that, I will invite our keynote speakers to deliver their opening remarks, after which we will get into a crisp panel discussion with our esteemed speakers who will join me at nearly about 4:30. We will have about 45 minutes to talk to each other, which will be followed by a question and answer session and a closing remarks at the end. So without further ado, I would now request Rupa to set us off through the presentation. So here we go. Rupa?
Good afternoon, everybody, and welcome to the presentation on the State of the Markets Report for 2024. The report really is a culmination of many months of hard work put in by our teams. We have interviewed issuers and investors. We have done secondary research on several emerging sectors and trends, and we have also analyzed sustainable finance market deals over the last 10 years that have been done in India. While it may be very difficult to summarize all this in a short 10-minute presentation, what we are endeavoring to do, Caroline and I, is to give you very quick highlights of what the report brings to you soon. Caroline will capture some of the very important data points, giving you an understanding of the size and scale of the market today and some key characteristics. And then I will take it from there, giving you a few insights on some trends and opportunities that we are seeing in the market today. Over to you, Caroline.
Thank you so much, Rupa, for that very kind introduction. And also for introducing the paper. As you say, there is a lot to say on the India market. We struggled to fit it all into the paper, and I will struggle to touch upon it all now. Have we got the presentation that we can put on the screen?
It's on
Yes.
now, Caroline. Can you see it?
I cannot, but I know what the content is,
Yeah,
so
we
that is
can see the
fine.
first slide here, which talks about the 55.9 billion market size.
Okay, hang on. Maybe I need to change my view. Let me do that. Hang on. Okay. Well, let me just see if I can do it from memory.
So let me just come in over here. Actually, Rupa, we cannot see the presentation just yet. So let's give it 30 seconds. Let's put the presentation slides on screen. I was just wondering if the other speakers and participants can see the screen, because I'm not able to.
Just to confirm, I can see the screen. It has USD 55.9 billion mentioned there, and table as well.
Okay, great. Okay, so that's super. So I'd just like to start off by reiterating the words of Neha and Rupa and say thank you so much for joining us today. I have been fortunate to contribute to this research paper, and it is my pleasure to contribute to the presentation, which, as you will see, describes India's thriving sustainable debt market. So when we talk collectively about green, social, sustainable and sustainability linked debt, we refer to it as GSS plus. And India has an active market for GSS plus bonds and loans. So much so that by the end of 2024, cumulative aligned GSS plus volume originating from India amounted to 55.9 billion US dollar equivalent. And that reflected a 186% increase since 2021. In 2024, 12.5 billion of GSS plus volume originated from India. So if we could go to the next slide, please. I still can't see the slides, so I'm just hoping that what I'm saying matches the content. So at the end of 2024, cumulative GSS plus volume had reached 5.6 trillion globally. And I believe we have recently crossed the 6 trillion, the 6 trillion US dollar mark in GSS plus volume. So among the countries that have a presence in this market, India's cumulative volume ranks 18th overall, sandwiched in between Belgium and Mexico, and it is the fourth largest emerging market source. The chart on the right-hand side of the screen shows the composition of other prominent emerging markets. Chile here is unique in that it's the only country to have deployed all 4 types of sustainable debt instrument by its government with strong leadership, so much so that 42% of the government's sovereign liabilities now bear one of the GSS plus labels. So next slide, please. Green is the favourite theme among the issuers and accounts for 83% of the total volume originating from India. This stands to reason, given the growth in low carbon energy, energy efficiency, low carbon transport, etc. in the region. These activities are well defined and they're traditionally debt financed, so we expect green bonds to continue this momentum. Climate bonds has got definitions for more than 20 other categories of green activities, including waste, agriculture, shipping, and many more sectors that are relevant to the India market, including those active in hard-to-abate sectors of economic activity like hydrogen, steel, cement. And as the decarbonisation imperative becomes clearer for those economic sectors, we do expect growth to be rapid here as well. So we think that that will catch up. Social and sustainability remain smaller segments, but we do see vast potential for these in the Indian market. As we saw on the prior slide, other emerging market economies have accelerated the issuance of sustainability bonds, for example, which is ideal if issuers do not have a large enough project pipeline of green bonds, and they can combine a few social projects to increase the size of the deal. The same can be said for the sustainability-linked format, but that is undergoing a bit of a retreat, and that is not just in India, that is globally. However, we do expect for that market to recalibrate and come back stronger. Next slide, please. So on the next slide, we can see that growth in the Indian green bond market has been led by issuers operating in non-financial corporate sectors, which is consistent with what I mentioned on the previous slide. This economic sector offers vast opportunities for renewable energy, low carbon buildings, low carbon transport, etc., all of which are activities that lend themselves well to this market. So industry can only transition through electrification. The green bond market is well aligned to absorb deals in those with those types of use of proceeds. Local governments, municipalities, etc., have remained on the margins of the GSS Plus market in India, but local authorities are permitted to issue autonomously. And climate bonds is currently developing an adaptation and resilience taxonomy, which will help these issuers to identify a broader range of project categories which are suitable for green bond financing. So there are 7 themes under our A&R taxonomy, including infrastructure, which covers water, and also other areas which must become more resilient to the ramifications of climate change, like housing and healthcare systems. So we will have definitions for all of those segments, if you like, of financing, and we expect that that could contribute to a balloon in the local authority and public sector financing segment in India. So the next slide, please, describes the currency breakdown of the Indian market as it stands at the moment. The US dollar is the preferred currency of Indian issuers with 55%, followed by the Indian rupee at slightly smaller 44%. One would expect this type of profile from any emerging market country, and obviously the strong USD presence gives rise to attracting a broader range of investors from diverse sources and from the international community to support the growth of the market. So that's fantastic. The next slide focuses on the increase in deal sizes that we've recently seen in the Indian market. So Climate Bonds has noticed that the deal sizes are increasing, which is enhancing investor confidence in the market. So Climate Bonds wants more investors to commit capital to dedicated green and sustainable debt mandates. This is a crucial part of our work, and the increase of individual deal sizes allows larger investors to get involved, suggests potentially more liquidity, although that is a bit of a sort of debatable subject for any area of the green bond market. But basically the benchmark size definitely allows the inclusion of a broader range of investors. So overall, we still see in India that the largest number of deals appear in the smallest category, but we have noticed growth in the categories for the larger deals as well, which is a positive sign of market development. The next slide describes the tenor of the market, I think. Yep, the next slide describes the tenor of the market, and Indian issuers again tend to preference shorter tenors, which is what we tend to observe across emerging markets broadly. So bonds with longer tenors will help to diversify the investor base in the market, of course, particularly among insurance and pension funds. So again, we expect this is another potential application of our adaptation and resilience taxonomy. We expect that will introduce more opportunities for issuers to bring longer dated bonds when we complete the definitions and the thresholds for the infrastructure segment of the taxonomy, which will allow issuers to identify investments in those spaces, which tend to lend themselves to longer dated tenors. The next slide is looking at the areas of growth for use of proceeds. So low carbon energy, as we've said, remains the largest use of proceeds, and that's as one would expect in any developing market, particularly in this space. The use of proceeds are very, very clearly identified. Project categories are well understood. And of course, these are markets that lend themselves very well to debt financing, as it were. The Indian market is very much a bond and loan market. Climate bonds captures loans on best efforts, but I believe for this data we have used a third party to ensure a greater degree of completeness. So that's what you see at the bottom of the screen. The next slide discusses the growth in the social bond market in India. I think the social market has demonstrated good growth in 2024 with 7 deals, and the combined volume of that market is now 5.5 billion. At the end of 2024, the cumulative aligned volume of social bonds from India was 6.6 billion, so that's very good growth. And the global market for social bonds stood at 1.1 trillion by the end of 2024. So the market is on a global basis is not huge. Obviously, it developed quite rapidly during and after the COVID pandemic as issuers came to the market to fund their recovery. And we have seen some momentum since then. And in India, in fact, prior to 2024, we saw 1 aligned social bond per year from 2018 onwards. So use of proceeds from India's aligned social deals is split between 8 project categories. Employment and microfinance, I think, are the largest categories, but there is vast potential for development in this market in India. The final slide discusses the sovereign green bonds that come from the Indian government. Now, what we typically tend to hear from sovereign issuers is that when they come to the green bond market, green market creation is an intention and also an outcome of their presence in the green bond market. We observed a greenium on many of the bonds that have been priced by the Indian government, which is very positive. There has been discussion that the greenium has started to diminish, but we don't see this as a huge problem. And, you know, we believe that the demand is there and the demand will continue to be very strong, both from domestic and foreign investors. So there we are, that completes my segment, and thank you very much for listening. Of course, there is a lot more detail in the report itself, so I do encourage you to read it, share it, talk about it and ask questions, and I'm going to hand back to my colleague Rupa for the next section of the presentation. Thank you so much.
Thank you, Caroline. So after that quick snapshot on the numbers, so here are some qualitative trends that we have observed in the market. Moving on to the first slide, as India is marching towards its decarbonization goal we would require close to 1.3 trillion US dollars for climate adaptation commitments by the country. And most of these, about 60% of that, 58% of that is expected to come from private sources, and the balance is public. The sectors which the investors are looking to invest in are large sectors which are mature, offering substantial sizes for investment and an attractive return opportunity. Renewable energy, which is green and solar, wind and solar projects, has seen the maximum amount of capital attraction, and it will continue to do so going forward. With the energy becoming greener, we need energy storage for stabilization of the grid, and one would see large amount of outlays in that space. So that we see as a sector which is, going to be very interesting and attracting more capital as we go along. And another sector that you see the other sectors mentioned here, energy efficiency across various sectors, energy transmission, but I want to also call out on electric mobility. As the transportation sector decarbonizes and OEMs scale up their capacities, I think this sector is poised for some interesting deals. It will see money coming in not only at the OEM level, but also money coming in to support the wider infrastructure for supporting e-mobility across battery, across various other infrastructure requirements for the decarbonization of the transportation sector. The next interesting trend is really on the hard-to-abate sectors. Sectors like cement and steel. The next slide, please. Yes. Sectors like cement and steel, an interesting trend is that companies in these sectors have also started accessing sustainable finance. A unique form of debt, which is, sustainability linked bonds, has been becoming more popular. And we see that companies here need to have a very clear commitment for reduction of their carbon emissions. And the tricky part here is, of course, we need companies in these hard-to-abate sectors to commit to a transition plan which is credible and which builds investor confidence. And that has been a little challenging in India because some issuers have been able to do that and some have struggled because India has some different sectoral pathways compared to what global expectors have already seen in other parts of the market. And we will have some industry experts joining in our panel discussion, explaining to us how they have steered this challenge. JSW stands out in its fantastic global sustainability-linked bond deal, which was the first global deal that any steel company has done in the world. The next slide, please. The third trend, which is emerging, is financial institutions, banks, and NBFCs have come out as a very prominent issuer category. You would ideally look at them as investors in, green finance. But what we have seen in the market is that with nudges from Reserve Bank of India for growing their green commitment in their own portfolios, banks, NBFCs, and FIs have been building green portfolios of their own and then coming into the market for refinancing this portfolio. This has also helped smaller deals access green capital, and that has been a favorable outcome because what is required is then an aggregation at the bank level, which enables a refinance of a certain size and scale that global investors are looking for. I want to call out only one issue here, that they do not really categorize and label their portfolios as green or social when they are actually doing out their loans. That would be an interesting trend to start, because it would then be very easy to collect homogeneous categories of loans and then get them refinanced in the market subsequently. You have large issuers like SBI, Canara Bank. When it comes to banks, you have FIs like REC, PFC, IRIDA. You have funds like Vivriti. So everybody has been raising, green bonds, all categories of FIs. And the other thing that has emerged is really the social bonds. We have also seen, Caroline just explained, the growth in the social bond market, especially 2024. 2024 has seen 1.8 billion of social bonds raised by NBFCs. They've also been all permutations and combinations of green plus social. So everything is selling, a lot of action in the FI space, and we feel this is a very interesting space for investors to look out. Next slide, please. The other interesting trend is the growth of municipal bonds as a very nice financing opportunity. Earlier this month, we saw Pune Pimpri Chinchwad issue a 200 crore bond, which was subscribed multiple times. And where is this coming from? This is coming because the requirement which is needed for as India's cities are growing and expanding, the financing required for urban infrastructure is humongous at $840 billion. The government does not have all the money to provide and has been urging the states to raise private finance. They have provided strong incentives so that ULBs, which is urban local bodies, access private capital markets. And since a large part of their infrastructure qualifies for green issuances, we have seen ULBs going and raising green bonds in the market. So these are typically for clear end uses that you can see here, water treatment, sewage treatment plants, setting up of parks, green spaces, etc. So this has been, again, a very interesting opportunity that we think climate bonds would love to track closely. And we are working very closely with some municipal corporations in supporting this agenda. Vadodara Municipal Corporation stands out among these issuances in their first certified green bond. Next slide, please. So who are really the investors, in this growing space of sustainable finance? We are focusing on debt. So coming to debt, you have both bonds and loans. Both are interesting opportunities in the Indian market. When it comes to bonds, you have the large global international players coming in like pension funds, asset managers, and equally interesting are presence of DFIs in this space. The development financial institutions have doubled their exposure to India when it comes to climate finance. Most of them have taken aggressive climate financing targets. We also see local Indian financial institutions like IRIDA, PFC, REC, all of them putting out large capitals towards both bonds and loans in this space. By the way, just a call out, we are doing a deep dive to understand nuances and investor preferences in this market, and we will be shortly coming up with a very nice investor survey. So stay tuned and watch the space for more nuanced understanding of the market. So to summarize, why I wouldn't say that we have really arrived. Sustainable finance is really yet to be mainstreamed in Indian banks and financial institutions, but nonetheless, it has made great strides and great progress, mainly because of 2-3 areas. One is because of strong policy support. We have seen the government announce their intention to have a very clear taxonomy. We have seen reports of green steel. We have seen cement companies coming in and saying, I will look at low carbon steel. We have seen support in the transportation side, strong policy support coming up from there as well as nudges from RBI and very progressive reforms which have come in from the SEBI side on issuances of bonds in this space, as well as ESG rating providers. SEBI has issued clarity on that as well. These policy and regulatory frameworks, I think, will reduce the risk of greenwashing and may give us a more robust framework for doing more deals. The other thing which is attracting more capital in this space is the diversification across sectors. We spoke earlier about a range of sectors which are available. The report details many more, although slightly lower, sectors which are, increasingly accessing green capital for their growing requirements. And lastly, we will also see a lot of innovation in this space, I believe, with instruments coming in and in greater customer or issuer and investor engagements, which we are seeing will lead to creation of innovative instruments. We are in discussion with several FIs, and if the budget itself has announced a NAPFID as supporting some kind of a partial guarantee scheme, which will enable more active participation in the local bond markets. So we expect that with these policy reforms, with investor engagement, with sectoral diversification, climate financing and sustainable finance will certainly help India achieve its decarbonization goals. That's all from our side. Over to you, Neha.
Thank you, Rupa, and thank you, Caroline. So, of course, please get your hands on a copy of the report, read for many more detailed insights. We had shared the advanced copy with our speakers today, so I hope you had a chance to look at that. But at this moment, I would request that everyone switches their camera on and be on the screen, and we can formally announce that the report is going live at this very moment. Welcome, Swaroop. Welcome, Shamik. Gaurav, I'll request you to please be on camera. Mr. Rao, Aditi, and others on screen. Can you please switch on your cameras? And so my colleague Bani, I think we are good to go in terms of the release. This is how you do it online. I mean, there isn't a stage, but we will pretend that we are all on stage and very, very happy with the release of this report. So thank you all. And if everyone has had a good photo moment, we shall continue with the rest of the proceedings of this afternoon. Okay. At this moment, without much ado, I would request Mr. Rao to deliver his keynote address to start with. Mr. Rao is the Executive Director at SEBI, and he has been a close, what I should say, I mean, one of the things that I have to mention is that under his leadership, we have seen nearly 9 to 10 circulars come from SEBI in the last year and a half. So there is much to be spoken about. And thank you so much for that leadership that you have shown at SEBI. But I will give it to you, sir, to actually set us off and what your expectations are from the Indian market. Where do you see the regulation can enable further? The stage is yours.
Thank you so much. It's indeed a great opportunity both to witness the release of this storm, I think you called it. So I'm delighted that we have both a capture of what has happened and indeed what is the potential. So I think if I had to begin, I would say that it's clear in terms of science and data that climate change is a reality and requires planetary scale solutions. The reality check is that at times, it is access to technology, access to, how we can go about doing a lot of it, which I think confronts often the global south. But at the same time, it is also the financing that is required And I think whether it is the climate bonds initiative, but also roles of regulators such as RBI or ourselves, which is to sort of nurture an environment to where that financing can take place. I would sort of build out in 2 or 3 strands of what SEBI's done and some of our plans ahead. I think the one sort of key movement was creation of a green debt definition or green bonds, as we call them. And I think this was introduced way back in 2017. And then we refreshed it in 23 February, where we reintroduced some of both the definitions, but expanded it such that there has been a recognition of blue bonds, yellow bonds, transition bonds, which indeed India needs, and several other things which were, for instance, around climate change adaptation, pollution prevention and control, circular economy being supported by issuance of such bonds. So to me, I think the menu of options that we made Green Bonds framework available was quite expansive, and that we did, like I mentioned, in February 23. Further, I think we drew lessons both from issuers market and what we saw investors demand for, which was introducing actually the entire framework around social bonds, sustainability bonds, and sustainability linked bonds. And the label we chose for them, despite Neha's request to us to call them GSS Plus, we picked a label which we saw our fellow regulator in IFSCA do. They label these as ESG debt securities. So we felt consistency in both the regulatory approach for them and us would be more better for India Inc. And which is why that's the terminology we chose. We call them ESG debt securities, but really it's an umbrella term for social bonds, for sustainability bonds, and for sustainability linked bonds. And as much as IFSCA is enabled, I think we adopted the same approach, which is we've cross-referenced all of the global standards, including climate bond standards, but also the ICMA green bond or the social bonds principles, the ASEAN standards, the EU standards. So it is giving issuers a whole host of options to, sort of select and put across when they are dealing with issuance of such securities. Around our own economy and what we expect, really, I think issuers will really need to step up, both in terms of the harnessing the green bond framework and the ESG debt framework that we have created. And if indeed they utilize the social bonds or sustainability linked bonds, to my mind, there will be both the expectation of the impact being measured of how some of these will pan out. And I think that is the other principle we've drawn from the global standards, which is trust but verify. So therefore, the structures both for green bonds and ESG debt securities indeed have third-party reviewers that are stipulated, and they can take form of second-party opinions, certifications, and affirmations, so as to speak, that indeed the purpose and so on has been checked by somebody and been done. I think, to me, the data was really, really both comforting and at the same time, I should probably add that a lot of it is also what is being done as foreign currency debt issuances. So we must acknowledge that IFSCA is really being one of the key movers in enabling a lot of it. But I'm happy that even other financial centers have sort of contributed, and the numbers are therefore quite heartening. But of course, I heard Rupa also say, and I saw that in the report, which is that our goals are far higher. I think it's in trillion of dollars that we need to mobilize. So we've barely begun, so as to speak. To my mind, we now have at some level an ecosystem which I believe can support all of it. We have frameworks like green bond and ESG debt securities. We have frameworks for reviewers to come in and operate. Very recently, when we did the ESG debt framework, we equally said that those that are registered with us as ESG rating providers could also extend the service of doing a third-party reviewer role. So that can be, as long as they manage the conflict of interest, we think again that's an area they can expand into. To me, what is next? I think I would put it as 2 or 3 policy objectives and how it pans out. One would be the creation of local pools of capital. We've been very successful in mobilizing local capital, whether be for equity raising, fundraising, or for regular bonds that are issued. I think extending it to really the green bonds or ESG debt securities, as we call them, or GSS plus, will be the next level of policy challenge, which I'm hoping we rise to. The second would be the ecosystem of providers of second party opinion, verification, certification. I think as long as there is integrity around what their role is and how they perform, perhaps the need for regulatory intervention is zero. But if that integrity comes under question, one should certainly expect regulators to take a deeper interest in both regulating and wanting to make sure that confidence and integrity is maintained. So I would just call that out as an area to watch, and people who are in that role having really a good sort of sense to make sure that there are no misadventures or wrongdoings. Because that purpose washing or that greenwashing can damage the entire sector rather than just one issue. I think the third element I would call out is we need skilled professionals in various elements of sustainability and sustainable finance all across India Inc. So whether it is at the issuers, whether it's at the investors, such reviewers, as we said, I think the skilling challenge is going to be a real challenge, which we need to support, which we need to create, whether it is training programs, whether it is creating education courses or skilling. I think that will be the third big challenge for us. The last, I think I would say, is that we are indeed conscious and we want to be supportive of figuring out solutions to support some of what I call impact or outcome linked bonds as well. So that is one area that we will examine. And we welcome inputs. If indeed Climate Bonds Initiative has seen that around the world, please do feed it to us. The way I describe it is that, if there is either a philanthropy or for that matter, outcome funders who are willing to sort of say, if these metrics are met, we are willing to pass on additional financial return or sort of a reward or sort of additional contribution, whatever other terminology is used. So that may drive again a further investor interest, further issuer interest in both stepping up and meeting some of the outcomes that we want to see. So whether they are impact or their outcome, as long as they are measurable and verifiable, I feel again that may create a new instrument category and attract investors and issuers. So I'll end there, Neha. But again, thank you for getting it to the stage. It gives a broad context of Indian market and where we have reached. But again, we've barely scratched the surface. There is a longer journey to traverse. And thank you for all your role in that, including driving the taxonomy and how we will sort of anchor it. I think we will wait for the taxonomy and then see those mapping also happen to our frameworks. And wish you all the success in that. And thank you again.
Thank you, Mr. Rao. I think those were absolutely on-point remarks for the growth needed and the kind of ecosystem developments and shifts that we are seeing. I do believe that some of these dots that had started to emerge are now starting to connect. And I think in the next 2 or 3 years, you will see a lot of momentum on the policy signals, on the regulatory signals, as well as that opportunity that newer kind of instruments and newer kind of structures can bring to the GSS Plus market. Mr. Rao, I would definitely request you to stay on because we will have a fantastic panel discussion on which will pick on some of the points that you have just spoken and hear from the ground, from the company's perspective, from the investors and lenders' perspective that we have coming up. 2 things that I wanted to add to the points that you made on market integrity, trust but verify, is actually when we talk to investors, we see that a very concerted investor outreach is also required. The amplification and visibility of pipelines is required because they are trying to look at where that predictability is, in which sectors, in which subsectors. And those are the kind of efforts that Climate Bonds with its partners is trying to engender and put together in the local ecosystem. The domestic market opportunity, I think, is huge, especially after the sovereign has come to the market, and a lot of interest has been coming to us from different actors, not only municipalities, Mr. Rao, but also financial institutions and companies to actually tap the domestic market. But at this moment, I think the demand, the explicit sort of demand, is still fledgling and nascent, and that may require a lot of nurturing, both from the policy as well as the regulatory side. With this, I would request that our speakers, presenters also look at the chat box. There are some questions already appearing, and I would welcome our panelists, Mr. Gaurav Bhagat, who is the Managing Director at MUFG, and our wonderful partner institution in this exercise. I would welcome Shamik Ray. He's the head debt capital markets, primary dealership at ICICI, and Swaroop Banerjee, who is vice president sustainability, JSW Group. I would like to actually begin our conversation with you, Swaroop. Since this is the toughest part, we touched upon only a little on transition finance and transition instruments. But here you are an industry major on the journey of decarbonization with, in fact, ambitious targets much ahead of the India's 2070 net zero. Your net zero target here is 2050. And you also have a very steep decarbonization curve that you have set for yourself till 2030. So I would like to understand two things to be very specific for the purpose of this discussion. It is really the use of these instruments, which are called sustainability linked bonds or SLLs, or even transition bonds. How do you see these instruments? Do you see these instruments as promising instruments to finance your net zero ambitions? And actually, how are you navigating the investor expectations, especially from overseas? And the third sub point, but a critical point, is that we just heard about transition plans, from Mr. Rao and earlier from Rupa. How are transition plans helping with designing of your financing strategies? Over to you, Swaroop.
Yeah, thanks. Am I audible?
Yeah.
Yeah. So at the outset, let me thank Climate Bonds and MUFG for organizing this webinar, and congratulations on the release of the State of Market report. I had a quick look at it, and quite a few interesting points have been evolved, talking about the evolving landscape of the debt financing that is presented in the report. Coming to your specific question, Neha, let me give you a context that JSW is operating in varied sectors such as steel, cement, power, infrastructure, paints, motors, and of which steel, cement typically fall under the hard-to-abate sectors. And when you talk about hard-to-abate sector, a significant amount of investment is needed to achieve the net zero targets, particularly in sectors like steel. And the traditional financing instruments may not fully address the needs of these sectors, and making the transition finance, including the SLBs and bonds, very crucial for these kind of sectors. As you're aware that JSW Steel was one of the first company in this sector to globally issue the USD denominated SLBs, and we had taken a target of net zero by 2050 and set ourselves the KPI of reducing the CO2 emissions intensity by 23% by 2030 from the baseline of 2020. So when we look at this particular aspect, these instruments, especially SLBs, attract a wider range of investors, those who are focused on sustainability and impact investing. and which suggests that the market is demanding that companies deliver sustainability commitments to access the capital markets. I think that was one of the learnings that we looked at. SLBs specifically incentivize the issuers to improve their sustainability performance by tying the financial outcomes to their performance indicators. Now, it also provided us flexibility by allowing to link the bond characteristics with the overall sustainability performance of the organization rather than specifying on a or being specific to a particular project, because that gives us the flexibility. We can implement projects across the company wide and achieve our overall goal. I think these were the issues that kind of we feel that it's promising that such kind of instruments will help the organization in their decarbonization journey. Now, but when we started our journey, we realized that it is important to have a lot of conversation with the investors, especially the overseas investors, because they come with a different context, with a different background of mature markets that they have been dealing with. The Indian context, which is completely different, and India in a growth and development phase, is important for them to make it clear that the ambition that we take or the trajectory that we apply is commensurate to the local context based on the challenges and the opportunities that are present and the availability of technology options. I think this has to be made clear and explained to them in a way that they understand this, because their expectation is always to align against the benchmarks of the Western world, typically Europe. So I think that conversation with each of the investors, saying that the trajectory that has been prepared, it is science-based, it is science-aligned, it is scientific. I think that's the first part that is important for them to be convinced that we are on the right track. Because they always come with a saying that Europe has this, we have to follow this. So I think that's not possible considering the situation in the context that we operate. I think that was one of your questions. And lastly, the transition plan. When you talk about the transition plan, like giving example of steel itself, JSW Steel, since we committed our net neutrality target to be by 2050, we have released our climate action report. And this climate action report details our transition strategy and the roadmap. And when we were preparing this roadmap, we believe that the transition plans are the cornerstone of industrial transition to a lower emissions. And when we tried to finalize this ambitious transition plan, we felt that because we have to be very clear and we have to be realistic in making the transition plan, avoiding superficial or high level claims which may not be achieved. So we have made, so if you look at our climate action report, we have considered two phases, phase one from now to 2030 and then 2030 and beyond. From now to 2030, we are sure that what we want to do, investing in decarbonization levers such as efficiency improvements, energy transition, scrap kind of increasing the scrap quantity or process efficiency. And this helps us in prioritizing the investments where it has to go, where the finances are actually required from now to 2030. Because from now to 2030 also is a time where we are exploring the decarbonization technologies, which would be focused on green hydrogen or carbon capture, because these technologies are yet to evolve. And creating a financial pool right now may not be feasible. It is, yes, we need to do investments to do kind of research and development, invest in research and development, such products, but which the application of these technologies will eventually evolve after 2030. I think this way the transition plans helps us in prioritizing where to invest. I think that's the key underline I would take from you when we have this. And if you have seen the recently released the carbon transition analytics, they have reviewed our transition plan and they have clearly stated that obviously they have made certain observations, but they have also stated that the plan is credible, which gives us confidence that we are on the right track. And one of the advantages of having this transition plan and talking to the investors is when the investors come with their perspective, it also gives us an opportunity to refine and work on our transition plan, which we can further improve as we move ahead in our journey.
Yeah, thank you, Sarup. And I know that Gaurav also has to catch a flight, so I'm a bit conscious of time. But thank you for highlighting those very key aspects. Just wanted to plug in something over here from Climate Bond side that we have in fact released a framework of corporate transition plans with 5 distinct hallmarks, and it'll be very good to see. Like the climate analytics has done, an analysis of your transition plan in terms of credibility or in terms of any kind of robustness that is required to be introduced further. That may be an interesting framework to look at, along with others that you're already referring to. Coming to you, Gaurav, MUFG has been growing the league table globally, making a lot of money out of green deals rather than fossil deals. So it is definitely, green transition is definitely a growth opportunity for yourself as a bank. But staying on the topic of transition for a bit, Gaurav, what do you see as trends that companies are employing, and what do you think they should do better and more of in order to really access, the investment to finance the transition?
Sure. Thanks for the question, Neha, and again, thank you for having me as a panelist. So we just step back and look at the context in which companies are today operating in. I think it would be not an understatement to say uh, that it's quite a challenging environment. I mean, you have, on the one hand, from an offshore perspective, and I hope I'm audible, the markets have been fairly choppy, given initially it was, with the coming in of the new US administration, the entire tariff saga, and then geopolitics and tariffs have been themes which have been kind of lead to a lot of volatility in the offshore markets. And irrespective of whether it's a transition theme bond or not, I think that has led to a big impact in terms of the number of issuances which have come out in the markets, because that has been lower than usual. Now, when we have that, and at the same time, if you look at the local currency market, and Shamik is here, and he can opine more on that, we have a completely different scenario where the regulator has actually been on a rate cutting cycle. And while we may argue that we have reached to the bottom of the cycle or not, but essentially what has happened, the local currency markets have found a lot of favor. So we have an environment which is volatile, which leads to doesn't really lend itself to decision making, and at the same time you have the local currency markets which are very, very attractive compared to the offshore markets. In this scenario, you will find that a lot of our clients are now focusing on efficiency and cost cutting or cost management, and they're solving for the cheapest financing solution. In many cases, what they're doing is that they may have their plans of actually accessing the offshore or the bond markets or the loan markets for a larger size transaction, which is thematic from a GSS plus perspective, but they are willing to kind of do a bridge funding in the interim to support their plans by tapping into the local currency market, which is very, very cheap. So you have that. But in the interim, what is happening is those conversations are very much alive. I think issuers for a scenario where those markets come back in a constructive mode, and the relative attractiveness of issuing offshore debt or basically doing larger deals comes back into play. And we are seeing that we are actively involved in helping our clients evaluating such opportunities, both and also preparing them. So a lot of time is invested in actually getting frameworks in place, getting them basically getting the necessary certifications in place, maybe the SPO in place, so that when the market turns around, those plans remain intact and the need remains intact. And that's what a lot of our clients are solving for. At the same time, I think the real opportunity right now is also to advise our clients, where a lot of the steps they're taking in terms of their financing frameworks is inherently lends itself to issuances under the GSS plus label, but they may not be aware. So what we are advising our clients is that, look, you're already doing this, but you're not doing this in a format which is familiar to investors. And we are helping those clients to actually set up those frameworks, if need be, getting the certifications, the SPOs in place. And that is an easier discussion because that means that the inherent business of the client itself is something which lends into such issuances. All we need to do is, present it in a format which investors understand, and that is also a really big opportunity. The last thing is that from an investor's point of view, while geopolitically the emphasis on ESG may have come down because of geopolitics, etc. But it remains very much ongoing from a below the radar thing. So people may not talk about it that much, but investors are very much ready to put cash to work. And to that extent, I think continuing this engagement remains very important. So what we're also helping our clients do is to continuously engage with investors and provide regular updates and update the ESG frameworks. In many cases, the framework was set up 2 or 3 years back. Certain changes are required. So a lot of preparatory work continues in the background to make sure that when the time is right, our clients can take advantage of the right issuance windows and come out and issue.
So it's keeping you busy. The business is there, it's keeping you busy, and you do expect also both a growth, maybe in the loan markets, domestic market, more in the immediate term. Is that what I'm hearing?
I think it's more of clients will do, in order of preference, they will first solve for local currency solution, either a loan or a bond. Then they will solve for a foreign currency loan, because foreign currency loans are cheaper than foreign currency bonds. And but in terms of, and we must keep in mind that the foreign currency bond comes with its own requirements of disclosures,
Sure.
as well as which are more, onerous compared to loan documentation, and
Sure.
also issuance size. So, people are content to smaller size issuances for the time being because they don't want to take a call in terms of raising large amounts of money if they're not able to effectively deploy that. So
Yeah.
that's also.
Yeah, thanks for those very important points, Gaurav. I'll move to Shamik now, who I know for a long time, and he's always the person who will inject a dose of realism. But I would hence ask you, Shamik, you've been engaged with the developments of this market as a primary dealer. I have a very simple question. What is it that excites you the most about the sustainable finance market in India? And the second part of this question is that there must be some aspects that you're not so excited about, because I know some of those things that you've been looking at. Do tell us that in order to really realize the potential of growth in this market, what is the current state, and what are the things that you would like to see happen?
So thank you, Neha. And first of all, I hope I'm audible.
Yes.
So it's a pleasure to be speaking, and thank you to Climate Bond and to MUFG for inviting me. And it would be remiss of me not to mention the report which you have come out with. And as a primary dealer, I was particularly excited to see the very detailed coverage of the green bonds issued by the Indian government. To be honest, possibly we would not have written such a detailed report for our clients. And this would be very useful for our domestic market to send to overseas investors to let them get a snapshot of what's happening in India on the government bonds. And while I will come to your question, I would like to submit to the listeners on this webinar that a large overseas investor who is investing in the government of India green bonds possibly has a dedicated interest. He is able to take a country view. He is able to take a view of our economy. He is able to take a rate view, and is even able to take a currency view on our on India. At a later stage, when we go to him with a rupee bond, because as you have covered and Gaurav and others have covered, the dollar bond market, while currently it's a bit inactive, is very big, very well understood by issuers and investors. The Indian currency market is local bonds market is not so well understood. So our thought is, as a primary dealer and as a local merchant banker, that this knowledge we investors will get of our market through investing through the green bonds of the government may transfer at a later date to green bonds or ESG bonds or ESS plus bonds issued by the corporate. So that's very exciting that it's one big step. It's one big foundation. It will not lead to money coming in tomorrow, but at the right time, it will lead to money coming in. The other thought I have is that we need local transactions to happen on the green bonds. So it's exciting that it's slightly exciting, to be honest, that we have some green bonds in municipalities, some sustainability bonds. Recently, one large conglomerate, diversified conglomerate, has issued a bond for 5 billion, where I understand that we had overseas investors as well as Indian investors. In the past, the NABARD has issued a social bond. We need case studies where an issuer can call up another issuer and say, hey, you did this 6 months back or 1 year back or 2 years back. What were the practical issues you faced? Who are the investors you worked with? Who are the bond houses who supported you on this as in arranging? Which is the climate sort of second opinion, professional opinion? Who are the people I should go to? So when you don't have any local case study, it becomes more difficult because any potential issuer wants to know that what are the pitfalls. To the best of my understanding, and I would just go to the policy side also, SEBI and all the other regulators have been very encouraging. They have a very detailed framework. In fact, we have more work done on the framework than on the execution of the bonds, which is always the case when you're starting a market, that the creation of the market takes more time and actual execution has not yet happened. So even there, I think there's some practical experience which can be passed on that this is how you do this. So this is what excites me. What does not excite me possibly is we have a very long road ahead.
Is that your final statement? It's a very long road ahead?
I would say that along with that, all of us need to encourage anybody who's planning to come to the market. We have to encourage all issuers because it is issuers who will create this market, that you have to walk the talk. If you have a slide on your presentation which talks about ESG or sustainability and so on, please show what additional efforts you have made to create a market which possibly is you're doing things pro bono. It's a kind of corporate CSR or charity. I think we should all encourage large issuers to do that. On the investor side, I think that there is a natural problem that we don't have dedicated capital, and they are very happy to support green transactions, and a lot of green transactions happen in our market, Neha, which are not necessarily labeled green.
Sure,
and where the rates are so tight that it's not possible to even get a greenium. And when you go to the issuer, he naturally will say that I get the finest rate anyway. Do I need to add the greenium to this, which I cannot get maybe? Do I need to add the green label? So I think that we have to try to find cases where the deal may happen, but there's a tipping point by adding a green label to it, which makes it doable for somebody who may not do it otherwise. And we have to try to do that to seed the market.
Yeah. And I think I will just echo that point. I think nothing works better than demonstration. So market learns from, the peers who are coming to the market. In terms of the benefits, in terms of the labeling, that, there isn't enough labeling happening. I think now that SEBI has also made it very clear that self-labeling is not going to cut it, there would be that regulatory pressure for people to label a green debt security. I'm using it in a broad sense, but I hear you when you say that for the because of extra steps that you have to take, you might just say that I will sit with this without a label. I'm getting the money that I want without any extra cost and extra effort, etc. But there, I think your point on case examples, your point on bringing the different stakeholders into one room is extremely important. And that is something that we will and we continue to do along with our partners such as yourself. Gaurav, I'll come back to you on the broader thematic category of ESG, bonds and loans. And you have been supporting some social bonds and loans, etc. Where is it that the maximum financing need that you are seeing come up? And do you think that the assurance system in this particular segment needs to be further strengthened?
Yeah, thanks for that. So if you look at a dominant segment which tends to issue GSS plus debt in India are banks and NBFIs. And some of them, like Shriram, have been some of the largest issuer of GSS plus debt just in the bond markets alone. And they've also been very successful in tapping the loan market. So, this is something which I was alluding to earlier, that it's not just them. If you actually pick up any large broad-based NBFI present in India, who's rated, AA plus or better. If you look at the portfolio, you will find aspects of the business which are actually already compliant. They already do what is required from a ESG social perspective. I mean, a lot of the portfolios do qualify. They either lending to the weaker section of society, even if it's a specific product, for example, even educational loans, right? It's just that they have not figured out, and a lot of them are actually debut or infrequent issuers, that if they just had to repackage and present it under a framework, it will be very easy to get a certification or a SPO to endorse that. And while it and actually do social loans, it has started as social loans simply because social loans are more affordable at this point in time. But all of these issuers we're speaking to are in the process of getting internationally rated, and we'll look at issuing dollar-denominated debt once the market presents that opportunity, because like all Indian clients, they're very cost sensitive. They realize the value of diversification, but within the diversification play, I mean, every time we compare a loan and a bond, in most cases, the bond loses out because of two reasons. One is taxation, the withholding tax bond. The other is that in general, on a like-to-like basis for the same tenor, bonds tend to be, somewhat more expensive. But having said that, the advantage of going to the bond markets is that it's a fixed income investor market, which is distinct from the loan investor, which is for the loan market. And a lot of our clients do see value in that, because they do realize that diversification has to happen not just in terms of the type of funding, but it's also the type of investors. And they do value that. So I think it's a journey. We are actually identifying clients where their inherent business automatically lends itself to such kind of labeling, working with them to set up the framework, and then accessing the loan market. In fact, it's quite interesting. There's a data point where one particular client of ours actually issued a labeled social loan, and that was that was a debut loan syndication, which was highly successful. They did a follow-on deal with another bank, which was not labeled. A lot of investors came that they would prefer to wait out for the next opportunity, which is a labeled issuance, because investors also have their KPIs where they need to have labeled instruments in their portfolio. So exactly the same business, the business has not changed. The client, the rating and everything is the same. The pricing is probably also in line with what has been happening. It's just that because it was not labeled, investors are also choosing to make that distinction and wait for the next opportunity for labeled debt. So I think there's the inherent merit of taking this journey with our clients. And as I mentioned, the fact that they are not issuing bonds is not because they don't want to issue bonds. It's just that it's an economic decision. At the same time, I think because of the inherent nature of the minimum ticket size required for a dollar bond issuance, should probably wait to kind of see that requirement and see the market provide that window where they are able to fund in line with the existing cost of funds.
Yeah, and thanks, Gaurav. And I think what you say is basically points out that there is a huge potential for growth, both on the bond side as well as on the loan side. And I think I will now look at go to both Shamik and Swaroop and take the question of local market creation and policy signals that are required, that you see to make that happen. Something that Mr. Rao also said, that we don't have dedicated pools of capital in the domestic market. So how do you really grow this market, right? For thematic debt securities. Shamik, to you first. Do you see the role of regulation and policy over here in creating local market demand? What would you like to see happen?
So on one aspect, on the framework, I think the framework is very detailed and very solid. And I was following keenly what Mr. Pramod Rao was saying about the skilling challenge. So I
Mm-hmm.
think that in India, we have broadly avoided greenwashing because we came late to the party. We picked up the lessons from abroad. There were some famous cases of greenwashing much earlier, but we have avoided that by having a framework. And the recent tweaks, as you mentioned, this self-certification going out, I think it will lead to more rigor, which may be issue in the very short term, but which will give a lot of stability and confidence to investors in the medium and long term. And possibly the other thing is that what is happening abroad, that green deals are happening, as I think Gaurav also mentioned, yet hushing is happening, that you don't talk about it. That also will not come because it will happen in a sort of solid way. I think that given the framework, there is also some hesitancy about pushing investors into something by force. We are trying to sort of encourage investors, encourage pools of capital without mandating something. I think that in any market, leave alone the green market, if you mandate things to be done, then it's done in an inefficient way and in a non-sustainable way. If you try to encourage it through signals like the government itself issuing green bonds, government encouraging certain entities to come to the market to issue sustainable and social bonds, I think you try to keep the encouragement discreet and you try to make it happen on economic terms. It may take longer, but once you create the market, it's not something which stops the day the subsidy stops. So I think we have to be patient and look to build something fundamental which will be sustainable also.
That's a very interesting point, and people who want to accelerate the growth of this market, not for any other reason, but to actually address the need to do this, because we need investments to come in. We need to front load, transition with both international capital as well as domestic capital. So the organic route to growth of this market does seem to take a bit longer. I hear the point that you're making, but we also see, or there could possibly be some role that mandates or targets perhaps could play also, because you know that in green sovereign bond, the insurance companies are supposed to, IRDAI clearly stated that they should be investing, and it would be counted against their investment portfolio anyway. So that kind of a thing, could that be translated, brought to bear upon the corporate bonds as well? I mean, those are kind of things that we are keen to explore and see the pros and cons of. Coming to you, Sarup, right now, you are a big major, and I would really like you to now sort of uh, tell us something in terms of the policy signals that you think should be in place, not only for big guys like yourselves, but to really increase the kitty of green finance to smaller players in a diversity of sectors.
Yep. Yeah, if you see, the policy and the regulatory frameworks have matured in the last couple of years, and it is creating and is evolving supportive environment for the entire market growth. And I fully agree with what Mr. Rao mentioned. Two key aspects. One is maintaining the integrity of the entire thing, where the third party who are involved do their job, so that we don't get into a trap of things that comes up eventually. and the second one is creating the talent pool and the lack of skill set which should grow. Uh, the recently released draft climate finance taxonomy by the Ministry of Finance is one big step in this direction, and I believe that it is creating an overarching framework for climate finance. And if you look at this document, there is a clear-cut focus on the MSME with the core principle of proportionate or proportionality criteria for MSMEs. So, which would help them, facilitate their inclusion in the finance framework, addressing their resources constraints, and ensuring that they also are in that smooth transition to the low carbon pathway. Now, it is now important to see how the financial institutions, the regulators operationalize this taxonomy, the next step. And in when we operationalize this taxonomy, what kind of support can be extended to MSMEs in areas such as targeted support for them. It could be simplified processes for their applications. And the most important thing is how do we build their capacity? Because we know MSMEs are not yet there in India. And how do we help them understand the importance of sustainability principles and how they can integrate this into their business model? I think these kind of things that we should be looking ahead when we start implementing the policy frameworks on ground.
Thank you, Sarup. I would really like to open the next 5 minutes to questions. There are a couple of questions that I see in the chat box, and of course, they had to be around greenium, right, Caroline? So I think I will direct that to you. You have, actually studied greenium, and we have been publishing these reports. Give us a little bit of a flavor on this, how this works in developed economies. What are your observations? And what should we be expecting? And is there a story beyond greenium?
Yep, so I have put a reply in the chat box directing people to look at the reports that we've published on this topic. So Climate Bonds spent 7 years very closely developing the discipline of looking at the greenium, which is preferential pricing that issuers can obtain by putting the green label on their bonds. And we've certainly managed to get a global conversation going on this subject. So the studies that we have done look at bonds issued in euros and dollars, but they can be from any country, including India. And what we managed to find was that compared to vanilla equivalents, green bonds do indeed manage to attract more attention in the primary market compared to vanilla equivalents. So consistently over the 7-year period, we saw that green bonds attracted higher book cover and the spreads tightened more aggressively in the primary market. We also were able to observe that around 30% of the bonds that we looked at priced inside their own yield curve. And further, we saw that in the immediate secondary market, bonds tightened much more aggressively after 7 and 28 days. We did lots of work on this subject, and there are many, many things I could tell you. For example, we looked at the green bond markets after COVID-19 during that period. We looked at the data, and also after the Russian invasion of Ukraine. And what we managed to see, what we managed to observe was really, really interesting, because we noticed that green bonds tended to maintain their liquidity when the market shut down, which from the point of view of an investor is absolutely priceless, because what that means is that they then have the flexibility to sell an instrument at a price that is to their satisfaction, when they may need to obtain funds, for example, to pay redemptions or something like that. So if you own a green bond, it's kind of like owning gold, I guess, in that you know that you will always be able to obtain a good price for it. One of the other things that I just want to touch upon that I think has been sort of alluded to in some of these discussions is the idea of attracting this dedicated investor base. So what we observed towards the end of the greenium study was that green bonds were attracting on average around 70% of dedicated or self-labeled green and sustainability investors. And this unique source of support is what really, really helps to keep a bid underneath the market. But this is, of course, driven by a shortage of credible investments. Now, what issuers told us on many occasions when we did surveys and exercises where we consulted with issuers was that there are many benefits beyond the greenium that green bonds can bring to themselves and their organisation. And one of the most interesting ones was the opportunity or the ability to tap in to this broader range of investors and to obtain deeper engagement. So, you know, treasurers absolutely love pricing green bonds because it turns them into kind of sex symbol. Ordinarily, when the treasurers roadshow, you know, people want to talk to them about the organization's financial situation, but when they put a green label on their bond, the questions come thick and fast, and the treasurer starts to feel celebrity status, really, really popular in the market. And this is, you know, these are genuine benefits because there are many investors who have money to put to work in the green bond market, and there is a massive shortage of capital. So at Climate Bonds, what we try to do is encourage more issuers to come to the market with credible projects, you know, to meet that demand. So I hope that is a bit helpful in giving you a flavour. I've added a link in the chat box to the green bond pricing research that we have done. We haven't done anything for a little while, but obviously I'm continually looking at it all the time because it's of personal interest to me. But you know, we definitely can say that green bonds do obtain pricing benefits. So that's a clear positive.
Yeah, thank you, Caroline. I know that we have come up on time. I'm trying to sort out a couple of questions, filter a couple of questions over here. I wonder if Gaurav can take any of these questions or any other panelist. They're mainly for the investors' lens. That are there current gaps in data transparency or integrity that still need to be addressed? Is it something that you would like to speak to, Shamik? I know that Gaurav has to catch a flight, so I'm not chasing him for this.
No, I think that more than the data, I think the investor understanding is somewhat limited. And maybe from the issuer perspective, many issuers are still learning how to present it. So I think on both sides, I think there's a lack of awareness which flows from fewer deals. So the deals
Sure.
need to be there to have the learning and then have the tracking thereafter. I went through, let's say, one of the social bonds issued by one of the large financial institutions.
Yeah.
It was a very simple document, and therefore it really did not need much data. I think that one of the points which Gaurav mentioned, that you have a host of financial institutions in India, and India is a very diverse country, and you're bound to find cases where you can add a green label or a social label. So the ability to have portfolios and these lenders, or it could be a corporate for that matter, which have large portfolios, which have suitable end-use portfolios, they will surely be able to present the data. I think that's how the data is sort of communicated and understood by investors. That's important.
Yeah.
Along with this, we also have ESG providers who try not to work on ESG bonds or whatever, but they try to work on the ESG aspect. So I think whatever work is done is helpful, but ultimately we need transactions.
Yeah.
We need more
Yeah.
transactions. Yeah. And I think
And
we
I
are getting there if we are getting domestic investors and foreign investors. And another thing which Gaurav mentioned was, I would like to add to that, the rate cuts in India have been front-loaded. The rate cuts, what I understand about the US Fed, which would affect the dollar market, are back-ended.
Yeah.
I think the dollar market would catch up by the end of this financial year, and then we would have more transactions. And I think that over time, we will try to slightly increase the domestic transactions, while of course the overseas transactions will happen much more. And last point is, I think that as a society, we have to give importance to this. If as a society, we are not giving importance to this, it is a bit more difficult to get the financial transactions in. I think we reflect what we do in our society, and all the awareness that we are creating, hopefully it is making a change at the level of the government, the economy, the stakeholders, the society.
Shamik, I think I couldn't have put it better than this. This could be the closing note for the for the conversation today. But before we do so, just to echo what you have said, get more transactions in, build more awareness about the benefits, both on the issuer and the investor side. The cycles of rate and interest rates will continue. Build the domestic market, preferably organically. But if there is a possibility of pushing this further through some kind of targets and mandates, explore what would it look like. With this, I would close the question and answer session and invite my colleague Aditi Bhatia from MUFG to give the closing remarks and bring us to a close for today's launch webinar. Mr. Rao, you heard some of these points. If you have anything to say, this would also be the time to say something as we close, before we close. Can I give the stage back to you for 1 minute, Mr. Rao?
Sure. Thank you again. I quite, both get the sense that, yes, there is that long journey, like Shamik was pointing out, which we need to traverse. Our frameworks are in place. Again, a thing which I keep reminding folks and saying is, while we have put frameworks in place, they are not ironclad in terms of that they will always be so. I think we remain flexible. If there is feedback, if there is things to change or tweak, we remain open to that. I think the point is that when we establish it, obviously we consult a set of stakeholders. But people who are actually going to be using it, getting impacted by it, when they come back, we remain open to sort of revamping or revising. So that's the only other message that I wanted to add to it, that the journey need not be only as per what is out there. It can change, it can be, sort of revisited if that's what the market requires.
No, thank you so much for that. And you, I think, have demonstrated this amply. I think the regulators, policymakers are extremely engaged on this topic to grow the market. With this, to you, Aditi.
Thank you, Neha. And first of all, congratulations everyone on a successful webinar and launch of the much awaited India Sustainable Debt State of the Market report. I'm sure it'll be referred to in the market as a benchmark and will hopefully lead to more sustainable finance flows. So look, I just want to take a moment to firstly thank our esteemed panelists today for sharing your valuable insights with us. And for contributing to the important dialogue on advancing climate finance in India. Thank you once again. Thank you also to our partner Climate Bonds. We have a strong collaboration model and hope that continues. And lastly, a big thank you to the audience that joined us today. It is your participation and your engagement which really makes these dialogues more meaningful and material. I would quickly like to summarize a few takeaways from today's discussion for everyone's benefit. In terms of the discussion and what the report carries, while green, social, and sustainable bonds and loans have been the bedrock in attracting capital towards advancing government and corporate net zero ambitions, the market will increasingly look to pivot towards transition finance. I think that was summed up pretty well by our panelists today, and is also evidenced in the report. We know that decarbonizing steel and cement itself requires a huge commitment, about USD 650 billion. So that's one of the strongest opportunities for transition-aligned capital in India. Secondly, robust and credible transition plans. Again, Swaroop alluded to it. These are key to attracting more foreign capital into this segment. And again, the report affirms this finding. We do see widening of the investor base with participation from the DFIs, from global asset managers, and from banks, which is deepening the secondary market liquidity. And lastly, I think a progressive push in the domestic policies and regulatory environment. It's a strong enabler and will help promote further growth in this segment, especially, I think, in the domestic debt capital markets. So we have SEBI's enhanced BRSR disclosures and the recent ESG debt framework that was launched, the RBI Green Deposit Framework, IFSCA's sustainable and transition finance guidance, and a forthcoming national taxonomy, which will further boost investor confidence. The growth in GSS plus issuance reflects India's accelerating net zero transition. And at MUFG, we remain committed to our clients to support their transition plans along with their economic ambitions. And with that, I would like to thank you once again for joining us today and hope you will enjoy reading the report. Thank you very much.
Thank you so much. To greater, bigger, bolder collaborations across the board. Thank you so much, everyone, for being part of this conversation today and to be launching this report today with us. Thank you.
Thank you. Thank you so much.
Thank you.